So, ladies and gentlemen, good morning and welcome to the ScaleUp Institute and British Business Bank finance session for scale-ups in the East and Southeast Midlands. I'm Stuart Rock, I'm from the ScaleUp Institute, and I'm going to be your compere for today's event. So I hope that your storm defences are up and that you have your coffee or tea with you. Over the past 7 years, it's been a hugely exciting privilege for me to work with Irene Graham, Josh Robson, and the team as the ScaleUp Institute as they become a true voice of influence up and down the country, helping to make the UK the best place in the world to scale up a business. Today's event focuses on scale-up growth capital. What are the trends, where and how to find the appropriate capital for your company's growth, and to get a better understanding of the wider ecosystem that you can tap into for support. And we've got a terrific lineup of speakers and a wealth of knowledge to share with you today. So if you've got any questions, make sure you put them in the chat. And we'll certainly make sure we refer to them all. So we'll love to hear from you. First, you're going to hear from my colleague, Josh Robson, who's the head of external affairs at the ScaleUp Institute. After Josh, you'll see a presentation from Lewis Stringer, the Senior Manager at British Business Bank, and then we'll hear from David Golding from Innovate UK. After that, there will be a panel session. First, we'll hear from Duncan Kerr, the CEO of Aristech, and then we'll be joined by Lauren Crawley-Moore from London Stock Exchange, James Syrachuk from Business Growth Fund, James Thompson from FinCap, and Ben Tickler from Silicon Valley Bank. The whole session will finish at 11:30 sharp. We'll make the slides available to you afterwards, so don't worry about taking screenshots, scribbling furiously. Let your coffee percolate and let your questions come forward. And so without further ado, my great pleasure is to hand over to my colleague, Josh Robson. Josh, the floor is yours.
Good morning, Stuart. Good morning, everyone. Thank you very much for joining us today. As you will see from our presentation, we've got lots of things to talk about in this area. And I think one of the things that's most important to recognise, and something which many of you will know as scale-up businesses yourselves, scale-ups are a hugely important part of the national and local economy in the UK. Scale-ups are more productive than average, they're much more innovative than average, and they're also much more international. So when we talk about the issues that they face, and when we highlight the ways in which businesses are able to access finance, what we're really talking about is the way in which we can really drive that growth at a local level in order to have the best and most formative economic impact that we can up and down the country. Scale-ups, again, useful to say and to highlight, scale-ups are across all sectors. This is not about a particular area of the economy in one way over another. And we find that businesses that have this kind of growth rate of being 20% or more in either turnover or employment, or both, actually tend to have more in common with each other when they're growing at that rate than necessarily across different sector verticals, whether they're in tech or whether they're in auto parts manufacture. The challenges themselves are often linked to that growth rather than the specific sectors that they're in. So when we look at the UK economy as a whole, and this is the reason why scale-ups are so critical, we can see that actually of all of the SMEs in the UK, 5.9 million, they generate 2.2 trillion, but we know that just 334,000 they generate half of that. So 33,000 scale-up businesses generate half of the entire SME economy. And that's something which can really be quite a transformational view of the way in which support at a local level is driven. When we look at it in terms of productivity, they're also more productive than average. And I think that's something which, again, really chimes with scale-up business leaders themselves, but can sometimes not necessarily feel quite so natural for people delivering services locally, or indeed figuring out the right ways in which to find support for those businesses. In the East Midlands, we can see that there are 2,100 odd scale-ups, with another 1,200 in the pipeline that are scaling. So there's sort of 3,000 businesses that are really forming sort of the groundwork of this economic growth and employing substantial numbers of people across the region and generating substantial turnover. You can see nearly 40 billion for the local economy. And I think that's something which really does sort of bring home just how relatively incremental changes at a local level and connecting these businesses into finance at the right stage can really drive such change across the whole place. And we can see when we look at the country, and we've been mapping clusters around the whole of the UK, there are different clusters developing. And in the East Midlands, we can see that actually there is a substantial kind of clustering around wholesale and retail, but also manufacturing. And that's something which, again, goes outside of these are scale-up clusters that are developing. That goes outside of the sort of idea that scale-ups are just in one particular area of the country, or indeed just in one particular sector. So when we look at scale-up businesses and the challenges they face, we can see that broadly challenges fall into 5 main categories. And that's usually access to finance, access to talent, access to markets, access to infrastructure and leadership development. We've been tracking this over a number of years, and this is what it looks like at a local, regional level. And we see that actually access to markets is pretty critical, and access to equity finance is also important up there in number 3. When we force rank it, we can see that access to talent locally is a real challenge, and that's something which often comes into or is part of one of the other challenges that businesses face. It can be accessing talent to find the right route to market, i.e. do you have the right sales director? Do you have someone who understands the export space and understands the way in which a business can be supersized and very much taken to that next level? Further, it's about understanding how those networks and how the way in which clusters and hubs can act as a catalyst for bringing people together can be really transformative for the way in which scale-up businesses can reach the next stages of their journey. We can also see that actually access to Innovate UK in the area is a critical factor, and it's something which we know actually access to Innovate UK can really drive additional raising. People who've accessed and gone through Innovate UK programs tend to raise more when they get to later stages of funding rounds than those that haven't, and this is something we've been tracking in our Scale Up Index across the last number of years. We can also see that actually scale-ups in the East Midlands are relatively high users of external finance, but what we're looking at is, do they feel like they have the right amount of capital to factor in for the rest of their growth? Actually, 5 in 10 are saying they don't have enough to meet their growth demands. So there is still work to do. And I think it's something which it's really, really important to lean into as an organisation, both ourselves, but also people in the ecosystem as well. And we also know that actually that single point of contact, 8 in 10 East Midlands scale-ups really would like a single point of contact. And I think that that's something which programmes such as those that are developing around D2N2 and others in the region can be really, really important to help them navigate the services that are there on offer and make sure that they're able to be identified and can fit very closely with their needs. Now, when we talk about this finance, we're actually talking about a continuum of finance. This is about helping a business to go through the whole journey, the whole escalator, from perhaps early stage grants, challenges, innovation loans, and other things which are available from either public sector sources such as Innovate UK, or indeed other sort of challenges and other sort of programs out there, through raising with an angel, VC, and then right the way up to IPO. And you'll hear a lot more about that from the panel later, and do ask questions of the experts and indeed the business that's kind of going to be sharing their journey on this later. I think the thing that's often challenging from an ecosystem perspective, and that I think it's often very important for ecosystem providers to recognise, and as businesses you will have probably experience of this, is that these different stages are one journey. This is one journey of a business. It isn't about lots of different silos that different businesses go into. This is about making sure that a founder that's looking to raise money has as seamless as possible experience to gain access to the next level, to the follow-on funding that they need to really fuel their growth. So to do this, we look at the Institute, we assess different programs that are out there in the market. We've done a whole range of assessment of different different things out there, and you can see some of the leading ones on the left, including those from D2N2 and others. We also have a Scale-Up Support Finder, which allows scale-ups to search for business support programs that may or may not be exactly what they're looking for within that area. And we've also been doing quite a lot of work on sectors, and we've been doing some work, as you may have seen, on investing in the creative sector, which has been reinvested in by government, and we're looking at doing more on next year. And just on the right there, you can see some examples of funders in the East Midlands who've provided funding to scale-ups. So without further ado, I think it's worth talking a little bit about the way in which these challenges are anchored in our work, and we look at these across a whole suite of recommendations to government, which are here. And this is obviously to a policy audience primarily, but actually you can see that each of the elements here hopefully chime and resonate with some of the challenges that you will be facing as businesses. And you can see the way in which we as the Institute and others within the ecosystem are working towards opening up those markets through R&D and procurement and export, and making sure that services are genuinely segmented towards scale-up growth, and making sure that scale-ups themselves have specific routes towards the programs that they need, whether that's growth capital, access to peer-to-peer networks, such as some of those we're running with Innovate UK, or indeed the right clusters and hubs to help them access the talent that's there. And that's something which data really facilitates. So without further ado, I'll hand back to Stuart, who will introduce the rest of the session. But do make sure that you're keeping your questions coming forward and really engaging with the experts that we have on offer.
Thank you. May want to take a look at that. Build back to you, but thank you. Yeah, thank you for putting forward these, putting things in the chat already. Now, our next presentation we're going to see is a presentation from Lewis Stringer at the British Business Bank. And Lewis, I know it's on record.
Good morning, everybody, and it's really great to be on today's webinar with the ScaleUp Institute. And my name is Lewis Stringer. I'm a senior manager covering the East and South East Midlands for the UK network team at the British Business Bank, and I'm delighted to again have a seminar with the ScaleUp Institute. This is the third one, and I just wanted to take the opportunity to thank the ScaleUp Institute for their support throughout the last 12 months. So, I work for the British Business Bank. Who are we? Well, the British Business Bank is 100% government owned, but independently managed, and we are effectively government's economic development bank. We don't lend or invest directly to SMEs, but we deliver our programs through existing delivery partners, and we'll come on to who those are a bit later on. And we do that in order to provide capital, more capital through those partners into the market to support more younger, growing companies in the UK to grow, to create employment, and therefore economic activity. So our mission is quite simple and straightforward. We're there to drive sustainable growth and prosperity across the UK and to enable the transition to a net zero economy by improving access to finance for smaller businesses. And we measure ourselves through 7 objectives, 7 KPIs. And I'd like to focus on a number of those throughout this morning's presentation. So how do we deliver those objectives and that mission statement? Well, as I said to you earlier, the way that we operate is through delivery partners, and they range from startup funding providers to more established high street, alternative, traditional lenders, asset finance providers, as well as equity finance providers, challenger banks, peer-to-peer lenders. So the whole range of different providers of finance in the current UK market. And we identify gaps in that market, ways and solutions and programs that we can put in place to address gaps in the marketplace and provide finance on behalf of government into the market to address those gaps in various ways through those delivery partners, and at the same time leverage private sector money either directly or indirectly through those delivery partners as well. As I said, we work with a large number and actually an increasing number of delivery partners, and this slide just gives you some of the examples of the types of funders and investors that we work with. So actually, what does all that mean? How successful have we been over the last 5 years? We've been around for almost 8 years now. So I've highlighted some of those earlier key objectives, KPIs, and actually what you see in 4 of those is an upward trajectory over the last 5 years. And strangely, even though 2021 was obviously quite a strange year for us all, being the first year of the pandemic, then actually a number of those key objectives actually increased and improved over that period of time. The most notable one is that 3rd one, where our aspiration to be a centre of expertise, to provide information for SMEs, as you'd expect, massively increased over that first year of the pandemic. The way that we categorise most of our programmes is either as a startup or a scale-up or a stay-ahead programme. And what you'll see on this slide are the various programmes that we deliver on behalf of government through those delivery partners in each of those three particular areas. They're effectively life cycle stages of businesses. And the funding ask and the finance ask will be different for those businesses at those various stages. So again, just a summary of the various programmes that we currently have in place. And then the next two slides separate those out into debt and equity solutions. And probably what I sort of shared earlier, as a public body using public funding, we look at debt and equity solutions rather than grant funding. And on this slide and the next slide, you'll see how the various schemes are targeted at certain life cycles, certain values of investment and funding, and at different levels of risk as well. And the equivalent in terms of equity solutions and the various programs that we have in place to provide equity solutions, as well as the earlier debt slide. So clearly we're here today to talk about ScaleUp with the ScaleUp Institute. So I just wanted to spend the next couple of minutes focusing on ScaleUp programs. So again, just to give you an indication that actually, probably pre-pandemic, ScaleUp was the primary focus of the bank. We were there really to address particularly equity gap issues in the marketplace to enable businesses to actually scale up, those with high growth potential. So there are a number of programs there. And again, some of our core programs pre and post pandemic are really around supporting businesses in the UK to scale up. I want to focus on two of those particular programs. The Regional Angels program, which as the name suggests, is a program to support more regional angel type investments. Again, one of our KPIs earlier, you would have noticed, is to address regional disparities in the availability of finance. And one of the ways that we do that is through the Regional Angels program. So we're encouraging more early stage angel investment type funding of businesses outside of the London and South East regions. And then one of our more established programs is actually the Enterprise Capital Fund, which actually predates the bank. And this is the program that looks at providing cornerstone investment in funds that target that real equity gap, that sub 2 million typically equity gap, that first round of funding for a lot of businesses, typically an area that the commercial investor struggles. So we act as the main limited partner investor in some of those funds, and you'll see some of the fund managers on the right hand side of that slide. Talked earlier about the regional disparities, particularly in terms of the Regional Angel program. We've also got a series of regional funds, again, to address some of the regional disparities that exist in the UK market outside of London and South East. And I'm delighted as the UK Senior Manager covering the East and South East Midlands that we do have a fund called the Midlands Engine Investment Fund that covers the 10 LEP areas, including those in the East and South East Midlands. And actually, I'm delighted to say that following the spending review in October, the £250 million Midlands Engine Investment Fund had a top up of 50 million, so it's now 300 million. And actually, we had a commitment to the next generation of MAF funds of £400 million. So a real commitment to levelling up and a real commitment to addressing regional disparities. That fund and those regional funds provide early growth, risk, debt and equity funding for businesses in those particular geographies because they experience particular issues by comparison to the rest of the country. So I talked about Midlands Engine Investment Fund. It covers the 4 LEP areas, local enterprise partnership areas in the East and South East Midlands. It is now a £300 million fund, and I'm delighted to say since these slides were produced that we've actually hit the £150 million milestone. It's actually £156 million worth of investments in 500 SMEs, actually 702 investments in total, and actually it's leveraged a further £251 million worth of private sector leverage. And again, you would have seen that one of the early objectives of the bank is to leverage the private sector marketplace as well. It would be remiss of me not to finish on what I do for the bank. I am part of the UK network team, and again, as part of looking at how the marketplace works on a regional and devolved nation basis, I am technically the eyes and ears of the bank in the East and South East Midlands. So I look to understand the region and how it operates, to share best practice around the UK, and also to strengthen the local finance ecosystems, to make them work better and to better understand as a bank in terms of how they do work, so that any programs that we put in place do identify and do address some of those more local issues. And I'm pleased to say that in terms of the East Midlands, in terms of our core programs and in terms of the Startup Loans Programme, the COVID initiatives and the Future Fund initiatives, which we also put in place, we've been able to support a significant number of businesses through some of those programs over and above the regional fund that I talked about earlier. So again, one of the KPIs and objectives of the bank that I talked about earlier is about becoming a centre of expertise. And again, that is not being arrogant, that's understanding that one of the key issues for a lot of small businesses is understanding the finance options that are available to them, being aware of them, identifying them, approaching them, but also probably most importantly, being prepared before approaching the funder. A key issue for most SMEs, irrespective of where they're located. So as part of that role of being a centre of expertise, we provide market insight and analysis. We also provide a series of tools. The most obvious one is the Finance Hub. And again, if you look on that link and look at the British Business Bank website, we have a Finance Hub, which very simply but very clearly sets out some of those finance options, how you match yourself with those options, become aware of them, identify them, approach them, but most importantly, be prepared for those funding options so that you can set up, start up, scale up, and stay ahead as a business as a result. So that's me done. I'm hoping the slides will follow. I've done a very quick canter through what the bank does and how we work on a regional basis, particularly in the East and South East Midlands. I would be delighted after today's seminar to speak to any of you in the audience. So please take my contact details. If you don't already know me, contact me. Let's start a conversation and let's see how we can support you. Thank you very much for your time, and I hope you.
Excellent. Thank you, Lewis. Perfect. You know, going spot on. And now, and you're here. Your internet connection is holding up. It would be just helpful to pick up from that sort of regional perspective. You talked about the regional angel program. Are you seeing more regional angels coming forward to invest in scaling businesses in the East Midlands, Southeast Midlands?
Good. And apologies that I had to be on the video. As a ScaleUp, as you will know, technology failed me early this week. So it's great to be back online and to speak at the seminar as well. And a great attendance as well, which is testament to the interest in the subject. Yes and no, Stuart, if I'm being honest. So the whole of the Midlands, not just the East and South East Midlands, I think doesn't necessarily have the formal, mature angel network that other parts of the country does. And obviously it's a very, very important first step in financing businesses and scale-up businesses. Angel investment can be very, very important. So we don't necessarily have the formal critical mass of angel investors on the patch, okay? Despite the best work of some of those partners, Minerva, Lincolnshire Angel Network, EMBA being some of those. We are seeing an increased awareness of the region amongst certainly some of our regional angel program deliverers, but there is much more work to do in that. And part of my role is trying to link those delivery partners with that local ecosystem. A plea from me though, it's massively important that when we do that, we present good propositions. Because again, that's where the reputation for the region as being a good place for those angel investors to invest in will be very, very important. So I think it's two sides. It's not only the supply of angel finance into the market, but it's also with our local partners, our LEPS growth hubs and other key stakeholders, making sure that businesses are prepared and investment ready as possible before they approach those investors. So we get an increasing reputation as being a great place to invest in.
Yeah, and you're going to see in the as if by magic and not scripted in chat from Frank Horsley talking about they're looking to establish a D2 N2 early stage angel investment fund and the help he's getting from you and the team. So that's good to see the sort of the energy that is happening out there. There's one question from Richard Gill, I see. Do you want to take that one about?
Yeah, no, absolutely, absolutely. Happy to do that, and good to see you virtually, Richard, as well. Hope you're safe and well. So it's interesting, isn't it? Because the true stats are, if you look at debt funding, both in terms of the commercial market, but also in terms of what the bank does, the East Midlands has a business base of between 6 to 7%. And actually, from a debt funding point of view, including the COVID schemes, the deployment was around 6 to 7%. And actually, it was very consistent across most of the region. Where we fall down in, which is probably the point that Richard's making, is around that equity, growth capital, risk capital side, where actually I'm still ashamed to say that in the commercial marketplace, that percentage is as less as 1%. Again, that suggests the benefits of having a regional fund, and our equity fund managers are playing a significant part, a 25% part in improving that disparity. But actually, coming back to Richard's point, if you look at the commercial market from an angel equity growth capital point of view, it's around 1% in the region by comparison to a business base of 6 to 7%. Much to do, and we all need to get together collectively and collaboratively to address those issues.
Brilliant. Thank you, Lewis. Now talking about getting people together and collaborating, it's really I should move across to introduce David Golding. So, David, if you reveal yourself for the audience, thank you. And great pleasure to introduce you. David's head of global innovation partnerships at Innovate UK. And you're lucky today because few people know more about how innovative scaling businesses get support than David. So, David, the floor's yours.
Many thanks, Stuart, and thanks and good morning to everyone. Share some slides. Great. So I'm going to talk to you today about how we help and support businesses to grow and scale, both domestically and internationally as well. So as Stuart said, I'm from Innovate UK, so I look after all the global activities, but I've been in Innovate UK since it was established in 2007, and so I've been involved in supporting and developing many of the ways in which we fund and sort of support businesses to, as I say, to grow and scale. And it's a great pleasure to be here today, and many thanks to the ScaleUp Institute for the invitation. So Innovate UK's national innovation agency. So we are there to support and help you grow and scale your business through R&D and innovation. And that's a range of financial support and also other support, which I'll talk about today. And very much supporting businesses across the sector and supporting businesses at all different stages of growth. So right from early stage startup right through to large corporates. And clearly today we're talking about, you know, how we help companies to scale on that journey. So we have a number of ways we do that, and very much the sort of, I suppose, the things which Innovate UK is known for, which is its grants in particular. And I'll talk about some of those in detail, as well as obviously some of the more recent things we're doing around finance, particularly innovation loans and our partnerships program, where we're linking businesses to investors. But a range of different ways we're supporting either businesses individually or through collaborations between businesses and universities or research organizations or our Casport centers. So a lot of you may be familiar with SMART grants. So these are the grants for individual businesses or collaborations in any sector, any area. So completely open, anything you want to apply for. We run 4 competitions a year. So you apply in, and we offer up to £25 million for each one of those competitions. So £100 million a year going into the program. We're hoping to sort of grow and scale that itself. But what I would say, it's very competitive. So we're funding between 6 to 10% of the applications we get. So very competitive. So only funding the best applications within that. But what I would say is, you know, it's a really good opportunity for businesses to get funding. If you're an individual business, up to £500,000 for the total cost of the project. If it's a collaboration, it's about 1.5 million. So yeah, again, good good way of getting funding into the business, non-dilutive funding. You have to put in some of the contributions, so it's matching, and for sort of small companies, we're looking at sort of providing 60% of the funding, you provide 40%, and then slightly different for medium-sized and larger companies. Something we've been running for a while now is our SBRI program. So this is slightly different to grant funding. So this is essentially procurement contracts. So the interesting thing with it, it's 100% funded, but it's really around responding to government challenges in particular. So we work very closely with various public sector organisations to look at how they've got particular challenges, which hopefully that small and medium-sized enterprises and other organisations can address. So a range of different topics coming through that, but certainly worth considering, particularly giving its 100% funding, often 2 stages. So often a sort of feasibility stage between sort of 50, 60,000 pounds. And then the second stage can go up to something like £2.5 million. So quite a large investment into a business, particularly at 100% funded, and obviously links to customers as well. And then we have our innovation loan. So something more recent that we've been doing, perhaps the last sort of 5 or 6 years. And this again is single company. We're offering innovation loans below market rate, so 7.4%. It's a competitive process, so you apply like you would for grants, and we assess the technical capability essentially of the project, and then we'll provide funding based on that. Again, it's competitive, less competitive than SMART. And loans can go from £250,000 to 1.6 million. And then our investor partnership program. So this is where we're bringing together Innovate UK grant funding with investment from VCs, business angels. I think Josh mentioned earlier, sort of, I suppose, the leverage that Innovate UK grant funding tends to have in terms of crowding in private investment going forwards. And we've made over £60 million available through grants, which are then leveraging in probably an additional sort of £70 million from private investment, and 175 million in follow-on investment. So very successful program, again, which we're looking at expanding further. And then looking at our non-financial support, so we have Innovate UK Edge. So this is where we have innovation and growth specialists across the UK, as well as 22 ScaleUp directors for our ScaleUp program, all embedded across regional ecosystems. So you'll have an innovation and growth specialist close to you, so providing one-to-one support for businesses. So rather than you trying to access programs, this is about how we bring someone to you to help you understand all of the different things which are out there, and then how we best help you access those or provide the support you need to grow and scale the business. So I say around 270, 280 people on the ground across the UK. Contact details at the bottom there in terms of web address. But yeah, if you want support from an individual person who can really guide you about growing and scaling the business, then there's people out there to support you, and all free and available to everybody. Then we have our Innovate UK Knowledge Transfer Network. So this is about helping you build the connections and links that you need and understand what's happening in different sectors and areas of technology. So the KTN has various groups you can join. They'll help you understand who's the right academic in your university in your area, or other businesses that you may want to link to. So lots of resource and connections there to help you. And again, all access through online, but there's people behind that to help and support. Then we have our Catapult network. So this is again across the UK, where we had world-leading centres in particular areas, such as cell and gene therapy, compound semiconductors, high-value manufacturing. And often these centres are providing access to equipment, facilities, skills and knowledge to help you develop your products or services, or helping you through other sort of almost consultancy type support to help you develop ideas within your business. There is some support through Innovate UK Edge to help you access these, so a bit of funding to help you connect and work with some of the catapult centres as well. So again, something worth considering. And then looking at global opportunities, so we have a range of programs to really help you look at international markets. We've focused very much around North America, Asia in particular for a lot of our programs, but we do go beyond that. And we have programs such as our Global Business Innovation Program, where it's a 9 to 12 month program, helping you really understand and explore potential markets, which includes often a week-long visit. Been slightly virtual over the last couple of years, but we're moving now back to sort of physical opportunities. And again, opportunity to really understand what markets might be right for you. And then we've got other programs. So we're looking at things like diversity and inclusion. So we have our Women in Innovation program, where we're working particularly with women entrepreneurs, and our Young Innovators program and Ideas Means Business, where we're working with young people who've just really getting a business idea off the ground and supporting them again through working with the KTN, Innovate UK Edge, and providing that wraparound support to them to really help them grow the business. So very early stage businesses. So both of those really looking at working with sort of diverse groups of people in the community. So pretty much a quick run through there. As I say, I'm very happy to help and support. If you want a follow-up conversation, very happy to do that. And again, thanks very much to ScaleUp Institute for the opportunity to speak today.
Great, thank you, David. And I'm seeing there's some questions have come up in the chat already for you. So one was from Paul Geary saying, can you please say when innovation loans will be available again, as they're not at the moment?
Yeah, we hope to have those available again shortly. We're just sort of agreeing the new funding from the government. So yeah, we hope to have those available again shortly, and we can update you on that. Yeah,
right. Okay, great. And there's also one from Richard Gill. It's just at the bottom there. You might see David, who applied for IUK grants previously. If applications are not strong enough to be supported for grant funding, could Innovate UK automatically consider the same application for other funding types, like loans, without requiring the business to make a separate application?
Yeah, so it's a good point, Richard. I think where we've got things structured at the moment, I think the grants have a view on the application in one way, and the loans look at probably more about the business as well as the application as well. So there's slightly different aspects. I mean, certainly I'll take that one away, and we can certainly think about it. It's something we have thought about before, as could we move things across. But we've got slightly different requirements between grants and loans. And I say often the loan, it's more a sort of a look at the company and not just the project and the R&D that you're looking to do, whereas the grant is much more about, I suppose, the project and the R&D. But a good point.
Yeah, oh, good as well. That's thank you, Richard. One general question for you, David. Innovate UK Edge and the sort of the wraparound support for the ScaleUp program that you're on. Do you need to be part of the Innovate UK, inside the Innovate UK home house before you can join or even participate in this? Do you need to have had a grant or any form of support already, or is the Edge program actually available to any scaling business?
Yeah, it's available to any scaling business. So we do work with all of the Innovate UK grant beneficiaries. So if you're in receipt of Innovate UK grant, you'll have an innovation and growth specialist appointed to you. So that's certainly part of it. But yeah, we're working with probably about 6,000 companies across the UK. Probably about 2,000 of those are actually grant beneficiaries, and the rest are non-grant beneficiaries. So no, it's completely open. Keen to work with lots of interesting, innovative companies. I see Jan Immel, who looks after East Midlands, has put the link in the chat to Innovate UK Edge. So many thanks, Jan, for that. So yeah, no, completely open, and yeah, lots of support out there. I think sometimes businesses don't recognise the amount of support that is available. So hopefully today we can sort of open up what sometimes people have called the sweet shop and welcome people in.
Fantastic. Well, that's great. Thank you, David. That's a really comprehensive sort of coverage, and thanks for answering the questions as they came up as well. So and we can now move on to talk to Duncan Kerr from Aristech. So Duncan, if you can reveal yourself. Thank you. There
Hi.
you are. Hi, good to see you. And I hope you're not being too much battered by Storm Eunice at present.
Well, I can see the trees are battling outside, but it's okay so far. None of them have come down yet.
Good. So, first of all, quickly give us a sense of Aristech, what it does, and what's the market opportunity that it's addressing. And then if you could also then give us some sort of sense of the metrics about the growth of the business to date by, kind of turnover or employees or customers, products. Give us a quick whistle-stop tour of what Aristech is and its growth journey.
Well, Aristech is an IP-rich company that makes electric motors that spin very fast and are very power dense. And their main application is to make electric compressors. And the market opportunity is absolutely immense for them. But the current focus of the business is on making compressors to provide compressed air to hydrogen fuel cells. And we are doing that in applications in automotive, in off-highway, such as forklift, tractors that take containers around ports, trucks, buses, and also we've, with the help of Innovate UK, and thank you very much for that, we've moved into aerospace as well, where you can appreciate that for large airplanes, battery electric is not viable because the batteries weigh too much. And there's also an interesting fact that I learned recently is that airplanes that burn fuel are not designed to land with a full tank of fuel. It causes too much stress, which is why they have to get rid of the fuel if they're forced to land in an emergency. But the weight of a battery stays the same when you take off and when you land, so that causes a real problem with airplane design. So that's our market opportunity. It's all around zero emissions and the move to no emission in transport and energy generation. We've also recently had opportunities to compress refrigerant for cooling systems, and there one of the applications is cooling battery electric, the batteries in electric cars, as well as heat pumps, which is going to have massive growth in getting homes heated emissions free. As far as growth concerned, metrics, last year we did about 1 million in turnover. This year we set to get 3 million, and we expect the following year to go up to 6 million. So we're creeping up, getting substantial revenues coming in. We're currently at 59 people. We've got around 8 vacancies at the moment. We always struggle to find people of the right caliber.
Is that, because presumably you're looking for quite sophisticated engineering and data skills?
Not so much data, but software, power electronics, and mechanical engineers, yes. Yeah. Embedded software across all that range, and coming out of the EU's made it even more difficult.
So take us about the financing path that Aristech has been on, because I can see there have been lots of angel rounds. There's been many grants. What have been the principal financial milestones in terms of the financing of Aristech, and what are you looking, because you've closed around last year in 2021, didn't you? So talk us through what have been the principal milestones in financing the growth of the business to date.
Yeah, I'll start in 2010 when I first came across the business. I was working at Midland, and I led the first venture capital investment round into the company. And I've stayed in contact with the company since then. Over the years, many rounds of mainly business angel investment. We have more than 100 individual investors in the company. If we go to so in 2017, we had a rights issue where we had to drop the share price significantly. But since then, it's been steadily climbing up. 2019, we were successful in applying for an AMSCI loan. That's the Advanced Manufacturing Supply Chain Initiative, a government-backed initiative to aid this, the supply chain. That was 2 million. We've drawn down 1.5 million to date, according to the milestones that were set, and we expect to draw down another 500,000 before the end of the year. In 2020, again, we were having very big difficulties because at the beginning of the year, we had 2 Chinese companies that had made offers to buy the business, but then COVID hit and that dried up, largely because the Chinese company won't buy a company elsewhere without physically visiting it, and that wasn't possible. But actually, that was a lifesaver for our business because we've grown in a different direction since then. We successfully had a loan from the Future Fund in 2020, and towards the end of that year, we applied for 3 collaborative Innovate UK programs. The total value of those programs are around 7 million. 2 of them are in aerospace and 1 of them in commercial vehicles. They've all made good progress and kicked off last year, and we're working with global tier ones. So GK in aerospace, in the aerospace application, and Cummins in the commercial vehicles. And the getting those Innovate UK grants helped us leverage finance, as was David talked about in his talk. So we closed a round in around February 2021 of 5.5 million. We're now opening our next round of funding. We're using brokers this time, but we're still raising private money, and we're targeting the venture capital trusts and EIS funds. So we're getting, I think, more mature in the sources of funding that we're approaching.
But how do you ensure that, I mean, if you've got more than 100 private investors already, their timescales are in line with the development of the growth of the company? There must be a lot of people who've already invested who are saying, "Come on, Duncan, where's our return?"
Yes. Well, it's been a long journey. The business has had to pivot. Its original concept that I invested in was that it was going to develop some technology and then license it to tier 1 players. At that time, the focus was on electric superchargers for internal combustion engines. That market opportunity dried up after Dieselgate. We've pivoted into hydrogen fuel cell, and that opportunity is quite early stage. So we're sort of like a startup that started up a few times. And yes, we do have frustrated investors that invested early on. We do think that we would probably do an IPO in 10 to 12 months, but there are also several tier 1s that are after buying us. So that's also a potential exit for our shareholders.
Yeah. And what have been the challenges of finding the right type of finance? I mean, in the last round, the 5.5 million round that you referred to, of finding the right investors at that, for that particular juncture. And then, as you say, what advice are you getting with targeting the VCTs and EIS funds this time round?
I think it has to be said that we weren't structured in that round. You know, we were pretty desperate at the beginning. The first investor that kicked off the round was actually, he runs funds that invest in listed stocks, so he's a fund manager. That round kicked off with $1 million from him. We then went to a broker who probably raised inappropriate money for us, because they were promising them that they'd do a quick flip into a reverse takeover and be listed on AIM, and they could, you know, sell out early on. We did actually investigate that route, and it didn't work. And we would be talking to sort of more up the food chain and brokers, and they informed us that we weren't ready for an IPO at that stage, because typically institutional fund managers want to see recurring revenue and you know, track record of growing revenue. And so they advised us that it would be good to go to the VCTs, because in their view, they have a lot of cash and not enough quality propositions to invest it in. And we qualify at the moment, we could raise around 9.5 million of VCT EIS qualifying investment. So there's a tax advantage for those investors to invest in the company.
Yeah, so it's and how important has been the environmental story, when you're talking as you're talking to investors? I mean, has that become something much more front and center of your pitch to investors?
It's absolutely crucial. We would have no chance without it. And you know, it was only towards the end of 2021 that the investment world woke up to the hydrogen story. And if that hadn't happened, I don't think that we'd be trading today. You know, over the years, there's been little interest in engineering businesses from private investors or venture or any venture capital funds, because you know, the flavor of the month has been internet and apps and the like, and blockchain, and you know, boring old making actual stuff and manufacturing has not really had much interest. And then the global warming issue and the potential for hydrogen to play a big part in that has woken investors up to that opportunity, and that really helped us and continues to do so.
Yeah. Now I see that Lewis has put a question in the chat saying whether, you know, why you think you've been successful in raising finance. Is it about the management team, the product, the market, previous experience, all of the above? That seems very.
I think, yeah, it's all of the above. Yes, they're all important.
Yeah.
Yes, and just in that journey for raising money, I think that you have to be able to express your enthusiasm for what you do and what you're doing in the market, and make it infectious, and then the investors catch on. Yeah.
But it's interesting. You said the advice that you've received is obviously clearly that sometimes you've been not quite had the necessary the best advice. What would you, when talking to other companies that are, you know, kind of they're in the listening in today, that they're on a growth path, but they're finding the way to how do they best use and best find the right advice to get them the appropriate capital at that point in their growth?
It's a good question, and I'm not sure I know the right answer to it. I would say that when you found a source of funding that you feel fits with your business, then raise a lot more money than you think you need, because nothing goes to plan, and you always have to go back for more. So having somebody who's committed for a longer journey is important.
Yeah, and that's something which in discussion when you're talking to investors, it's really important to kind of understand and challenge them about what their timescales are, what their patience is for their investment.
It is, but so sometimes the phrase "beggars can't be choosers" comes to mind. When you're running out of cash, you sort of put aside how ideal your potential investor is because you need to survive.
Mm-hmm. So you got to, yeah. So but it sounds like you're no longer a beggar.
Yeah, I think that's true. Yeah, we have options, and we have billion euro tier ones looking at wanting to buy us. So there are different options that we see now.
Well, it's very so it shaped 2022 is shaping up as an exciting year for you.
Absolutely. We're having a few of our products come to the maturity where we can sell them in volume, albeit small. But yeah, it's going to be a very good year for us, I think.
Fantastic. Well, that's brilliant to hear.
Duncan, the one thing that I keep pinching myself over is that we've just won a project with the biggest automotive tier one in the world. So that's a massive endorsement for our technology.
And that's kind of getting in. I mean, being in those tier one companies and getting that kind of endorsement is absolutely crucial and very, very difficult to achieve. I mean, again, it's a long-term game getting into them.
It is, but it is. We find it quite strange that over the past 3 years, most of our inquiries for hydrogen fuel cell have come to us. We haven't gone to look for them. So the message seems to be getting out that we're the go-to company for high-speed, efficient compressors.
Right. Well, I hope the world comes to you in greater numbers as well. So
thank you.
Brilliant. Thank you, Duncan. That's been really fascinating, and thanks for sparing the time, and very best of luck with 2022, and yes, making the world a greener place. So I've now got to invite our panelists, Lauren, the two Jameses, and Ben to join us. And thank you, Duncan. You can. You're happy. You're now. You don't have to stay on screen if you don't wish.
Okay. Thanks very much.
Thanks. So we have and great. We have our panel here. Thank you very much, team, for joining. I wonder whether normally we have gone around the table first, but I'm going to pick up on a couple of questions that have come into the chat, and which slightly echo something that Duncan was referring to there. The question from the chat was from Glenn Windsor, and I know that Lewis has responded in the chat, but there is a wider conversation. Glenn said, as a long-established company, not EIS or another sexy healthcare or online sales app, Wisdom has developed a world-first tech solution to the issues of poor broadband and potential downtime through cloud services, SaaS ransomware attacks. But we are struggling to raise equity investment, not attractive to angels without EIS, apparently not big enough for VCs. So we fall exactly into your equity gap, with no one yet seeming to be interested in supporting us. And Glenn's point was echoed by Jackie Kavanagh. Same here, Glenn. We're in the event sector with a SaaS product as well. We're hit badly, but no one will touch our sector, or that's how it appears to me. And it made me think whether the question is, does too much equity growth capital chase after particular sectors and ignore ones that aren't apparently in fashion? And here, I shall open it up, but maybe James Thompson first, and then James Sirocci. James.
So I think from a public equity point of view, certainly there is a tendency to err towards technology or certain financial characteristics, as Duncan mentioned, being sort of recurring revenue and high cash generation. But there are certainly sectors that investors will look for, and they may be more specialist investors that take the event space or kind of outside of the sexy tech space. It's just all a matter of sort of finding the right people, and unfortunately that process now is kissing a lot of frogs before you find the right sort of funding.
So the money is there, it's just harder to find.
I think that's right. As long as as long as there's a strong management team, robust financials, evidence and growth, all the things that are sort of generic characteristics of a good business, there will always be funding around. It's just a matter of finding exactly what type of funding is there for you, whether that's venture capital, venture debt, crowdfunding, public equity, all those sorts of things. It's just, as I said, a matter of either finding an advisor or going it alone and just trying and knocking on every door and seeing who's there. But it's certainly not an easy feat.
Yeah. James, sorry, how does that reflect on the businesses that you're seeing and the pipeline of businesses that you're seeing from the BGF perspective in the region?
Yeah, so morning everyone. I think first thing I say, I think investors can be a fickle bunch, which isn't always helpful. But fundamentally, I agree with the last panelist there that there's a lot of funding out there, and I think any funder will look at just the key fundamentals of a business. So it's quality of team, it's growth rates, it's what the market potential is. Now, I think specifically for that question that was on the chat, I think if people are finding that they're kind of a bit too small for sort of proper VCTs, or they don't qualify for EIS, then there are angel investors out there who will invest outside of EIS and aren't part of VCTs. So UK Business Angels Association is quite a good place to look on that specifically. But more widely for the question, I think from BGF's point of view, BGF is an active investor, growth capital investor in the UK. Typically, we're investing in slightly larger, more established businesses, but we do have an early stage part of our business. And actually, pipeline is incredibly strong at the moment. 2022 certainly started positively off the back of a really solid 2021. We invested nearly 600 million last year across the UK. Of that, about 42 million was across the East Midlands region. So predominantly Nottingham, Derbyshire, Lincolnshire, Leicestershire. So actually opportunities are strong. There's a demand out there, and it's just finding the right partner for your specific business or the specific opportunity.
Lauren, can we sort of just pick you up before, because then there's another question in the chat which I'm going to throw straight to Ben. But what about growth equity capital, chasing after being interested in particular sectors? I mean, how's that reflected with companies coming to AIM in particular?
Yeah, I mean, there are standout sectors, so tech, green, sort of ESG directed businesses, obviously, and healthcare is the other one that we've certainly seen in the last 12 to 18 months. But I would say that we had 126 IPOs last year. It was an incredibly busy year for everyone, but especially for public markets. And they were from a really broad range of sectors. So whilst there are those sort of standout sectors and areas like tech continue to grow and seeing lots of businesses come through from a pipeline perspective, there was a really broad representation of businesses and from across the UK regionally as well. So I would suggest that, and going back to the James's point about being able to tell a good business story, the same is true in public markets as it would be in some of that sort of pre-IPO funding. Good management team, good business plan, good prospects. It's the same, and if you have those things, then people are generally willing to listen to that story.
Thank you, Lauren. Maybe I can come to Ben now. Ben, while we've been kind of discussing, and I might have seen in the chat from Daljit Chima about PharmaSeal and best advice for debt-based funding, and here he is with building a B2B SaaS platform. You can answer his question, but it's also a very good way in which to introduce kind of Silicon Valley Bank and kind of what you're doing in the market, where you fit in terms of providing growth capital for ScaleUp.
Yeah, thanks, Stuart, and yeah, thank you to the ScaleUp Institute. And this is great. I don't think I've ever seen so many questions on one of these, and I've done 3 or 4, so keep them coming. So yeah, I work for Silicon Valley Bank. We purely focus on the tech, innovation, and then sort of life science or healthcare sector. And just specifically taking the question, yeah, it's really interesting now for sort of less. There's lots of forms of non-dilutive capital out there. So I will talk about the market versus just SVB. We do offer revenue-based financing. There's lots of people out there, be it venture capital backed fintechs or more established institutions that will help you, that will essentially provide a loan alongside your recurring revenue. So you look like you are a SaaS platform. You're growing very, very strongly. So you could leverage that. There's the likes of Pipe or CapChase and lots of providers now. As I said, Silicon Valley Bank does do that as well. And what you could also do, if you are going to carry on raising equity, there's then other forms. I think James mentioned venture debt earlier, so you could complement that equity with some venture debt. Again, I don't know if you're profitable or loss making, but to summarize, you can definitely access revenue-based financing solutions, and that's becoming more and more popular. That may or may not come with a warrant, so they could be a lot less. Well, they are a lot less dilutive to raising equity. If you want to raise equity, you're growing very quickly, you can also supplement that with debt, and that is known as venture debt, which we've been doing for 40 years as well.
Thank you, Ben. And maybe just be talking to you to get your attention. And can you say about the things that you're either declining or at least redirecting to other sources rather than being appropriate for yourself? Just to be helpful to sort of pin down the sort of the particulars here.
And sorry, Stuart, you cut out in the middle, but I think the question was, if it's not right for SVB, how are we sort of introducing, or was that?
Yes, what it was both. At what growth stage does the business need to be in order to be attractive and interesting for you, and what do you decline or redirect?
Yeah, no, absolutely. And look, we certainly can't do everything. And I think where financial technology as a sector is really booming is, you've got so many players, and a lot of them are backed by venture capital coming in for a particular product. So, look at Wise, used to be TransferWise, they've really focused on foreign exchange. So I would say typically if you've raised a minimum of $5 million, that's when we can look at venture debt. And, our recurring revenue based financing, again, we're typically looking for sort of 500K plus MRR, monthly recurring revenue. And that does mean the company is quite at scale. I think under that, there are some really, really slick digital solutions. The question there is, where you can get access to your cash very quickly. It's then just more about the long term. So if you are signing up to some of these players who have got amazing UI and products, it's then just what would a facility look like in the future? Maybe when a Silicon Valley Bank could come in and help.
Great, thanks, Ben. That's very helpful. I mean, actually, James Sirishuk, with BGF, and it'd be helpful to get a bit of context of what you've been investing in the East and Southeast Midlands, and also what the investment range is. I mean, is $1 million in equity too small for BGF? Is 20 million too big? Give us a sense of that as well.
Yeah, no, absolutely. So from BGF, I mean, we are a regionally based investor, so we have 16 offices all over the UK. Specifically in the area that we're talking about, we have an office in Nottingham, we have an office in Milton Keynes, and there is a bit of crossover. So 4 counties out of Nottingham: Notts, Derbyshire, Leicestershire, Lincolnshire, and then obviously Northamptonshire, North Cambridgeshire, encompassing Peterborough as well. So quite geographically wide coverage, but we've been very active. We've invested about 150 million now in about 19 businesses in that area. And more recently, some slightly larger businesses we've invested in, but our focus really is to invest across the spectrum. So what we don't do, we don't invest in early stage, we don't invest in sort of seed businesses. We can look at sort of series B and C, but really from a check size point of view, Stuart, as you specifically asked, typically about 1 million at the lower end, up to 15 to 20 million at the top end per transaction. So investing 600 million last year, that was across 65 different businesses. Some of those had 20 million, some of them had 1 million or slightly less. And where we're at the smaller end in our world, really that's in your disruptive businesses. So there's quite a bit of early stage life science businesses in there, technology and so on. The sort of sectors you'd expect where you are getting consistent growth rate on a strong basis, throughout a period of time. But I think for any investor, not just BGF, it's about relationships and getting to know businesses. So I think for any businesses that are growing out there that are on this call, even if you think, well, actually, we just don't need 1 million now, or we don't need funding yet, but we might in the future, there's absolutely no substitute for getting to know investment partners in advance of that, because with my investor hat on, it's much easier to back a business that we've known for several years, that we've seen grow, we've kind of been part of the journey from afar, and we've seen the business deliver on what they said they were going to deliver, than it is to just turn up to a business and find out they have a funding need and they need that money in 1 month, 2 months, 3 months time. So building that network of your own contacts is really, really important. And although, as I say, BGF might be at the slightly higher end for scale-up businesses, actually scale-up is really, really important to us, because clearly they are the businesses that we will be investing in the future.
Yeah, no, well, I might hold you back, but I was just to talk to you about your approach to co-investment. Do you often invest alongside others, or does BGF prefer to be the single investor?
No, we're very happy to invest alongside others. So we have, if I kind of take a cross-reference of cross-section of our portfolio, about 450 investments currently. I'd take a stab and say I think probably about 100 of those will be co-invests. So we're very comfortable being the sole investor, and typically as businesses get bigger, we are the sole institutional investor. But certainly in the earlier stage part of our business, we're quite consistently investing alongside other funders, some of those VCT funds, Downing, Calculus, Mercia. It's quite common. And for example, we invested in a couple of businesses in Nottinghamshire, one called Locate Bio and one called BioCity, which were certainly alongside other investors too.
Great, thanks. Thank you, James. Other James, is it your sense that there's more knowledge and take up of equity funding among scale-up businesses than a few years back? What's your sense about the understanding and awareness of equity finance as a growth capital?
I think actually equity finance has been more competitive from an investor point of view than it ever has before, in terms of the sheer pools of capital around that marketing efforts of investors to get into businesses and raise awareness about their funds is probably at an all-time high. And then you couple that with what has been a very buoyant IPO market on the public side over the past 2 years. I think that all that equals is essentially company awareness that the funding is available. And then even at the much smaller scale, crowdfunding, angel networks, they've all sort of professionalized themselves as well. And that all just, I think, gives potential companies confidence that there is some sort of funding around for them that's suitable.
Does the issue of loss of control still hold back people from taking equity finance?
So my role at ThinkUp is I sit on the public market side. So it's always a great argument for me to sell to companies why they should float rather than take private funding, because retention of control is a big management worry. But then again, unless it's one of these very sort of voracious private equity funds that sort of bail companies out and try and take massive control, I'd say on the whole, my experience of sort of private capital is that whilst they obviously want to have a a right to protect their investment, the instances where they come in and actually try and wrestle control from management would be in the instances where something is going terribly wrong in the first place. If management are doing a great job, then it's kind of counterintuitive for whoever's providing private finance to go in and change it, really.
It's interesting, and maybe you referenced in there about floating. So that good prompt to bring Lauren into the conversation here. Lauren, what are the myths, and are there particular myths or misperceptions held by young, growing companies, fast-growing companies about conducting an IPO? That what are the big misconceptions that you need to keep on sort of tackling?
I mean, James brings up one there, right, which is about this sort of concern around loss of control, and a lot of the investment in public companies, a lot of that is passive investment, and it's really about laying out your plan to investors and delivering on that plan. And if you continue to deliver on that plan, there's a biannual reporting process, and it's not the same as having investors that are acquiring those kind of more regular updates. So I would suggest that that's the first one, and James demonstrates that's obviously a conversation that he has a lot as well. The second one I would say is people think about LSE and the FTSE 100 and big businesses and perhaps those sectoral specialisms as well as being the main targets. But one of the things that last year really demonstrated to us is that whilst we had this huge number of businesses come to market, half of them were on AIM, which is our growth market for small and medium-sized businesses, which really demonstrates this huge appetite for growth companies with good stories, and from a broad range of sectors and from a broad range of regions, 4 of those coming out of the Midlands area. And then coming even into this year, we had a Birmingham-based business just this week come to market, and 10 IPOs so far this year. So, and there continues to be a strong pipeline of businesses, as I say, from lots and lots of different places across the country doing lots of interesting things outside of those sectors as well.
There's a question in from Richard Gill here. I've been told in the past to IPO as soon as possible. So when should a company consider its IPO? James first, and then Lauren, if you'd like to pick that one up. James Thompson, that is.
Sure. So I think if we look at typical public equity investors, I would say the sort of critical mass of when you start to get the larger funds involved is where your valuation would be anything north of sort of 30 to 50 million. Anything below that, I think you would candidly rely on more the sort of private client brokers and EIS VCT funds who can take a sort of slightly longer term view. So I think it depends. It's kind of horses for courses, really. If you are a smaller company but you're looking for a smaller size raise, then you can probably float slightly earlier than if you're looking for a significant investment, sort of 20 million plus on a 30, 40, 50 million valuation. So I think the key thing is always early engagement with advisors, because companies, each company is different. So there's no sort of one size fits all approach to when a company is ready to IPO.
Yeah. Lauren, take the same question. When should a company?
Yeah, I mean, that's right. And you've heard me say this before, Stuart, but I always say, come and talk to us. It doesn't, whatever stage of growth you're at, we're always interested in having those conversations. And perhaps for the same reason that the other James, wants to speak to businesses, at that early stage, we're keen to see those companies through as well and follow them as they grow. But the company that I mentioned that joined this week, that was a 28 million market cap and an 11.5 million raise. So James Thompson's right. That's a good kind of bracket to look at, but there are other examples of slightly below that and of course upward from that. So, but I would always say that yes, engage with your broker or come and talk to us, and we will always deal with, have a look at companies on an individual basis, and it is so dependent on a variety of factors. So if it's something that you think you might consider whether it's this year, next year, or in 5 years' time, come and have a conversation with us about it, and we'll be able to give you some guidance there around preparations for that, and when that might look like a good opportunity for you.
Yeah, and a very interesting point in the chat you'll see from Jodie Downs about the 15 million at IPO, now valued at 415 million. Not sure loss of control is an issue if you seek long-term growth, but if you can deliver on that, Jodie and team, then congratulations. And yeah, absolutely. Can I have 1%, please? The question, I mean, and you've also talked there about sort of early engagement. It would be interesting to hear from you all about whether you talk to each other about businesses that you have seen, but it may not be right for you at that time, or they, what are your relationships like with others in the advisory and finance ecosystem? How much time can you, and what scope is there for a business that, if it's accessing one of you, is actually going to be feel confident they might actually be accessing quite a lot of you in a wider network? Kind of James Syrachuk first, and then James Thompson, but I'd like you all to address that, please.
Yeah, absolutely. So for us, I suppose I describe that as almost signposting, or helping businesses out. We want to be able to support businesses in many ways, even if we can't directly invest in them. And actually maintaining that ecosystem of network contacts is really, really important. So quite consistently, if we meet a business that actually isn't right for us at the moment, whether that's for size reasons or any other reason, we'll always try and be supportive and find or point them in the direction of either another investor or an advisor who is well placed to help them sort of find what they're looking for at this point in time. Because ultimately, I come back to what I said earlier on, we want to always be an option on a business's journey, and actually at various points on that journey, we may not be able to be an option, but we necessarily don't want to rule ourselves out for the future. So being helpful, supporting the wider institutional investment community, advisory community is absolutely key. So yeah, consistently we will use our own network to pass businesses on if we can't help them, but we know someone that can.
James Thompson, same question.
Yeah, so I think part of FinCap's push over the past 5 years is actually to fully service scale-up businesses. Where we've come from a public equity background, we've now built out private capital and debt advisory team. And so we have touch points with businesses such as BGF, where our equity sales guys will speak to their listed equities business, and our private capital team will speak to the private team. And then our debt guys will speak to people like Silicon Valley Bank. So I think for us, it's all about trying to provide as many options to scaling businesses as possible. But again, as James says, if it's something that we really can't help, we're always happy to sort of pass on to either another advisor or a type of fund that we don't typically speak to, and sort of keep the relationship going, but give them honest feedback that we can't really help them, which I think is sort of another key thing that advisors need to do, is they need to sort of put their hands up and say, we're not best placed to do this for you, and point you in the direction of someone who is.
Yeah. Ben, is that the same view? You must, because you've got rather specific group of companies that will be talking to you in the first instance. Is it easier for you then to sort of route them through if they're not right for you?
Yeah, and I would just build, exactly what the two James were saying about being helpful and providing options. And we sort of have this ambition to be a trusted advisor, and part of that is saying, look, this isn't for us, but this is how else. And actually, over sort of 15 years in banking, I was just thinking about, I've got people at various different funds, and Boost & Co. and Hercules and Krios, and people have even gone in to become finance brokers. So yeah, part of my job is to say, look, it's not for us, but why don't you go and speak to these people? So it's very important.
Yeah. And Lauren, same, again, because presumably, if companies can maybe, if they come, especially if they talk to you early, how well plugged in and can you be to take them to the right, to give them the right directions, to access the right kind of capital?
Yeah, I mean, we will definitely do that as part of those conversations. If the IPO is not the right, right time or the right place to follow the kind of public markets route at that stage, then we're always very happy to have conversations around actually what should they be doing right now that will get them there. What are those kind of interim stages? And part of my role as part of our primary markets team and more broadly the rest of the team is really about ensuring that we have that network of contacts across the advisory community, across the investment community, and that's part of our job. So yes, absolutely, we will do that, and we're a sort of we're a neutral middle ground. So very happy to point people in another direction if that's what they need.
Yeah, great. So the real lesson underpinning this is kind of, if you go and have a conversation with one institution, kind of look to see how they can help you, effect introductions to others if that conversation isn't going to come to directly, immediately, the direct results. I've got one question for you, which is, again, a broad one before, and you have to be speedy and you're wrapping up here. ESG credentials and the net zero agenda, they're a much central focus, as we heard from Duncan in his talk. Are you allocating more weight to ESG considerations in your investments and how the markets, how you're seeing the market respond to this? James Thompson first.
I think there's sort of two strings to that argument, and I'll try and be brief in that. Yes, if you are a company that is doing something that boosts ESG or is green, there is certainly a heightened interest in that from an investment point of view. But sort of with the shoe on the other foot, actually, investors are more and more asking any company what their ESG credentials are, which I think can, on the face of it, be quite a scary thing if you're a small business with, say, 30 people and someone's asking you, well, what are your CO2 emissions? How much waste do you have? All those sorts of questions. But it's basically doing what you can, and investors do understand that you can't be hiring a chief climate officer and all these sorts of things if you're a scaling business. So it's putting policies in place like anti-slavery, ethics policies, monitoring your energy, all those sorts of things, and trying to make minimal adjustments when you can. And it's it is becoming, as you rightly say, a very hot topic that people want to know about, and they funds themselves are now having to report about the ESG credentials of their underlying investments. So it's something that people do have to keep an eye on.
Quickly, other James.
Yeah, absolutely. I mean, ESG has been a focus of BGS for some time, and really, I think outside of investment world, it's just incumbent upon all of us to sort of make the right choices and do what we can. So, I mean, when considering investments from our point of view, we absolutely have a focus on ESG matters. So, when assessing an initial business, we have to ask questions. We have to report internally around, okay, where does this business sit in its sort of journey? But what I would say is, agree with what James just said. Not every business is going to be, the sort of perfect article. But for me, it's about the impact that we can have on lots of businesses that we touch, that we're invested in, and that we work with, and ultimately having the most impact on the UK, the world, from an ESG angle is ultimately how we're going to achieve success. So I think acknowledging that all businesses are at a different point in their ESG journey needs to be done, but actually being mindful of how we can support those businesses to continue in that journey and work with others to help them is really, really important. So not just sort of flavor of the month in terms of the buzzword, genuinely something that isn't going anywhere and is really important for us all to focus on.
Thank you. Thank you, James. Sorry, Lauren, I know you'd want to talk about the green economy, Mark, but we don't have time because we're 11:29 and I've got to welcome, first, thank you, Ben, Lauren, and the two Jameses for a terrific conversation. But we are now going to hand back to Lewis and to Josh to bring the event to a close.
Thank you, Stuart, and thank you to David, Duncan, the panelists, James, Ben and Lauren as well. fantastic discussion, which just demonstrates that the East and South East Midlands is a great place to invest in. From my point of view, thank you to all the attendees, great attendance today. Thank you personally, Stuart, for hosting a great seminar, to Irene, Josh and the team as well for supporting us over the last year. Look, you've got my contact details, people. Please contact me. Let's start a discussion. Certainly next year, we'll be looking at setting up a particular ScaleUp working group to identify these issues and also to, more importantly, put some positive actions together. So thank you very much for your time. Keep safe. Over to you, Josh.
Thanks a lot, Lewis, and thanks to everyone who came along. Just a quick thank you from me to everyone and for your attendance. There's a poll on screen. Do please fill it out. It just gives us a bit of a direction on where we go next with this amazing series. So many thanks to everyone who attended, and we'll see you soon.